Most people who buy life insurance guess at the amount. They pick a round number that sounds big enough and hope for the best. $100,000, $250,000, maybe $500,000 if they are feeling cautious. But guessing at your life insurance coverage is one of the most expensive mistakes you can make. Too little and your family is left scrambling. Too much and you are overpaying every single month for coverage you don't need. In this video, we are going to walk through exactly how to calculate how much life insurance you actually need based on your real financial situation. No guessing, no round numbers, just a clear framework you can apply today. Let's start with the most widely used rule of thumb: 10 to 12 times your annual income. If you make $70,000 a year, you need between $700,000 and $840,000 in life insurance coverage. If you make $100,000 a year, you need between $1 million and $1,200,000. This rule exists because it approximates how much money your family would need to replace your income for a decade while they adjust, pay off debts, and rebuild financial stability without you. But a rule of thumb is just a starting point. Your real number depends on several specific factors. First, debt. Add up everything you owe: your mortgage balance, car loans, credit cards, student loans, personal loans, all of it. Your life insurance should be large enough to wipe out every dollar of debt, so your family inherits assets, not obligations. Second, income replacement. How many years would your family need to replace your income? If your spouse has a strong income of their own, maybe 5 years is enough. If your spouse doesn't work or earns very little, 10 years or more may be necessary. Multiply your annual income by the number of years you want to cover. Third, future expenses. Do you have kids? Factor in the cost of raising them and putting them through college. The average cost of raising a child to age 18 is over $300,000. College adds another $100,000 to $200,000, depending on the school. These are real future obligations your family faces if you are gone. Fourth, final expenses. Add $15,000 to $20,000 to cover funeral costs, estate settlement fees, and any immediate expenses your family will face in the weeks after your death. Fifth, existing assets. Subtract what you already have. If you have $200,000 in savings and investments that your family could draw from, you don't need to insure that amount. Your existing assets reduce the coverage you need. Here is how the math looks for a real example. Take a 38-year-old earning $85,000 a year with a spouse who works part-time, 2 kids ages 6 and 9, a $350,000 mortgage balance, $40,000 in other debt, and $75,000 in savings. Income replacement at 10 years equals $850,000. Mortgage and debt equals $390,000. Kids' college fund equals $200,000. Final expenses equals $20,000. Total need equals $1,460,000, minus existing savings of $75,000. Final coverage needed is approximately $1,385,000. That is a real number built on real obligations, not a guess. Now here's the good news. A $1 million to $1,500,000 term life insurance policy for a healthy 38-year-old costs roughly $50 to $80 per month. That is a cup of coffee a day to fully protect your family's financial future. A few other things worth knowing. If your spouse stays home to raise the kids, they need life insurance too. The economic value of a stay-at-home parent runs $150,000 to $200,000 per year when you factor in childcare, household management, and transportation. Losing that contribution creates real financial hardship even without an income loss. Your coverage needs change over time. As your kids grow up, your mortgage gets paid down, and your savings increase, your need for life insurance decreases. Many financial advisors recommend reviewing your coverage every 5 years or after any major life event like a new child, a home purchase, or a significant income change. And employer-provided life insurance is not enough. Most employer plans offer 1 to 2 times your annual salary. That covers maybe 1 or 2 years of income replacement. It is a benefit worth having, but it is not a substitute for your own policy, especially since it disappears the moment you change jobs. The bottom line is this: stop guessing. Add up your debt. Estimate your income replacement years. Factor in your kids and your existing assets. Then get a policy that actually covers what your family needs. 20 minutes of math today could be the most important financial decision you ever make. This video is for educational purposes only and does not constitute legal, financial, or professional advice. Always consult a qualified professional before making any decisions. If this helped you, subscribe. We cover insurance and financial topics in plain English every week. No jargon, no sales pitch, just the facts.